Hey there! When you hear the word investing, what comes to mind? For some people, it's flashy Wall Street traders shouting into phones. For others, it's complicated charts full of numbers they don't understand. But here's the truth. Investing is a journey. And just like wealth, it has levels. Some people are stuck at the bottom, barely making any returns, while others are playing at a level where their money grows faster than they can spend it. And if you don't know what level you're on, you can't move up. In this video, I'll break down the 6 levels of investing, from the safest and simplest strategies all the way to the high-stakes world of insiders and millionaires. So let's start at the very beginning, where almost everyone begins. Level 1. The savings account. If investing was a video game, this would be the tutorial stage. At level 1, you're not really investing yet, you're saving. Your money sits in a bank account, maybe even a high-interest one if you're lucky. Why do most people start here? Because it's safe. The bank won't lose your money, and you can withdraw it anytime. It feels secure. But here's the catch. It's also the slowest, least powerful way to grow your wealth. Let's break this down. The average savings account in many countries pays between 0.01% and 4% interest per year. Meanwhile, inflation, the rising cost of everything, often sits between 3% and 8%, depending on where you live. What does that mean? If your bank gives you 1% interest, but inflation is 5%, you're actually losing money in real terms. Your account balance might go up, but what that money can buy goes down. It's like running on a treadmill. You're moving, but you're not getting anywhere. Why people stay here? Fear. They've heard stories of people losing money in stocks or crypto. Lack of knowledge. They don't know where else to put their money. Short-term goals. They need quick access to their cash for emergencies or big purchases. And to be fair, a savings account does have its place. If you're building an emergency fund, money you might need at any moment, then yes, keep it in a savings account. That's your safety net. But once your safety net is in place, keeping all your money here is like trying to cross an ocean in a paddle boat. You'll never reach the other side. The mindset shift to move up from level 1. Stop thinking of your bank as the place where your wealth grows. Instead, see it as the parking lot for your cash before you send it somewhere more productive. At this stage, the goal is to get comfortable with the idea that money can work for you, but only if you let it leave the safety of the bank. Example, let's say you have $10,000 sitting in a savings account earning 1% interest. After 1 year, you'll make $100. But if inflation is 5%, you've effectively lost $400 worth of purchasing power. That's the hidden cost of staying at level 1. This is why many people who stay here for decades never see real financial growth. Their money is safe, but slowly shrinking. Level 2. The index fund investor. If level 1 was the tutorial stage, level 2 is where the real game begins. At this point, you've realized that keeping all your money in the bank is like trying to grow a tree indoors with no sunlight. It's safe, but it'll never reach its full potential. So you step into the world of index funds. What's an index fund? Think of it like a basket of many different companies' stocks, all bundled together. Instead of trying to pick one company to bet on, you own a little piece of hundreds, sometimes even thousands, at the same time. For example, in the US, you might buy an index fund that follows the S&P 500. That's 500 of the largest companies in America. In other countries, it might follow your national stock market index, like the FTSE 100 in the UK or the ASX 200 in Australia. When the market goes up, so does your basket. When the market goes down, your basket drops too. But because you're so diversified, you're less likely to see dramatic losses from just one company failing. Why people love index funds? They're simple. You don't have to be a stock market genius. They're low cost. Fees are tiny compared to actively managed funds. Historically, they've beaten most professional investors over the long term. Over the past few decades, the S&P 500 has returned about 7 to 10% per year on average after inflation. Compare that to the 1 to 4% from a savings account, and you can see why this level is a big leap forward. The downside: index funds still move with the market. That means in a bad year, you might see your balance drop by 20% or more, and for beginners, that can feel terrifying. But remember, investing in an index fund is a long-term game. The goal isn't to sell when things get bad, it's to stay invested so your money can recover and grow. Example, if you invested $10,000 in the S&P 500 and it grew at 8% per year, in 20 years, you'd have about $46,600. In a savings account at 1%, you'd only have $12,200. That's the power of compounding at work. Level 2 is about learning to trust that process. You're no longer just saving, you're truly investing. Level 3, the stock picker. This is the stage where many people get excited and where many also get burned. At level 3, you stop investing in the whole basket and start trying to pick the best individual apples. You research companies, look at financial statements, study their products, and decide, this one's going to grow. I'll put my money here. The upside? If you choose right, your returns can beat the market. For example, Apple's stock price has gone up more than 4,000% since the early 2000s. Amazon grew so much that early investors became millionaires with just a few $1,000s. But here's the problem. For every Apple, there's a company that looks promising and then crashes. In fact, most professional fund managers with entire research teams fail to beat the market consistently over time. For regular investors, it's even harder. Stock picking requires a lot of research, the ability to control emotions when prices drop, patience to hold good companies for years, even decades. Why people move to this level? They want higher returns. They enjoy the challenge. They believe they can spot opportunities others miss. The risk: one bad decision can wipe out years of gains. If you put all your money into one company and it collapses, you could lose everything. That's why many experienced investors still keep most of their money in index funds and only put a smaller play money portion into individual stocks. Example: let's say you bought $5,000 worth of Tesla in 2012. By the end of 2021, that could have grown to over $1 million. But if you'd put that same $5,000 into a company like Blockbuster in 2005, Level 4, the real estate owner. If levels 1 through 3 were about financial assets you can't touch, level 4 is about something you can physically stand on. Real estate. This is where you step into owning property, not just to live in, but to make money from. It could be buying a rental apartment and collecting rent every month, owning a small commercial space and leasing it to a business, even buying land that you expect to increase in value over time. Why real estate is attractive. You earn passive income from rent. Your property can appreciate in value over the years. You can use leverage, meaning you borrow money, like a mortgage, to buy the property, and your tenants effectively pay it off for you. The catch: real estate isn't as hands-off as index funds. You have to deal with maintenance, taxes, and sometimes difficult tenants. Plus, properties aren't easy to sell quickly. If you need cash fast, it's not as simple as clicking sell like in the stock market. But many investors love real estate because it's tangible. You can drive past your investment. You can renovate it to increase value. And historically, in most places, real estate has gone up in value over time, especially in growing cities. Example: if you bought a small rental property for $200,000 and charged $1,200 in monthly rent, that's $14,400 per year before expenses. Over a decade, if property values rise, you could sell it for $300,000 or more. Plus, you've collected rent the whole time. Level 4 is where wealth starts to feel real, literally. Level 5, the business owner. This is the stage where you stop relying only on other people's businesses to grow your wealth and start building your own. Owning a business can be the fastest path to massive wealth, and also one of the riskiest. Unlike owning stocks or property, your income here depends on your ability to run and grow a company. Why people take this leap? The upside is unlimited. You control the decisions, the branding, and the direction. You can sell the business later for a huge payout. The risks. Most small businesses fail within the first 5 years. You may work harder than you ever have before. Your income can be unpredictable at first. But if you succeed, you're not just earning profits, you're building an asset. A profitable business can be worth 3 to 10 times its annual earnings if you sell it. That's why many millionaires have at least one business in their portfolio, even if they also invest in stocks and real estate. Example: imagine you start a small online store that makes $100,000 in profit each year. If you sell it, you might get $300,000 to $500,000 or more in one deal. And if you don't sell, that $100,000 can keep coming in year after year, like your own personal dividend. Level 5 is where you go from investor to creator of wealth. You're not just moving money around, you're making new money exist. Level 6, the insider. If level 5 is about building your own business, Level 6 is about playing the game from inside the control room. At this stage, you're not just another investor, you have access to opportunities most people never see. This could mean being an early investor in startups before they go public, getting invited into private equity deals or venture capital funds, owning a significant stake in a company and influencing its decisions. The average person buys stocks after they're already listed on the stock market. Insiders? They buy them years earlier at a fraction of the price, sometimes pennies per share. By the time the public can invest, insiders have already multiplied their money. How do people get here? They've built networks of other high-level investors and entrepreneurs. They have capital to invest in big deals. They've proven they can spot opportunities and manage risk. Example: think of companies like Facebook, Uber, or Airbnb. Early insiders, employees, founders, or early backers got shares before anyone else. By the time these companies went public, their tiny early investments had turned into millions, even billions. But there's a catch. These deals are often illiquid, meaning your money could be locked up for years. They're high risk. Many startups fail completely, and they're invite only. You can't just walk in off the street and join. This level isn't about luck. It's about positioning yourself so that when the right door opens, you have the connections, credibility, and capital to walk through it. At level 6, you're not just watching the game, you're in the room where the rules are made. Conclusion. So there you have it, the 6 levels of investing. You don't need to leap straight to level 6. Even moving up one level can completely change your financial future. The important part is to know where you are now and start climbing. If this breakdown helped you see your next move, hit the like button so more people can find it. Subscribe for more step-by-step money guides and drop a comment telling me which level you are on right now. I read everyone. Remember, every big investor started small. They just didn't stay small. Your journey starts today.